I'm Anthony Smith with HFG Trust, and this is the Chart of the Week video. Hello and welcome to our weekly video. The Fed announced this Wednesday that it will accelerate its tapering of bond purchases such that it'll be done by March of next year and will thus be in a position to raise interest rates sooner than it had guided to just about a month and a half ago. So a conclusion or an ending of quantitative easing and rising interest rates would represent a tightening of monetary policy. One of the storylines this week has been that growth stocks might be at greater risk than value stocks in a tightening environment. And that narrative really had some legs yesterday on Thursday, when the growth stock index was down 2.1% on the day, while the value stock index was actually up 0.7% on the day. I thought it would be interesting to share a little bit more about the why in this week's video. Why would growth stocks be more at risk if financial conditions are indeed tightening and interest rates are potentially going up? And the answer is that, at least relative to value companies, the bulk of growth company earnings and cash flows are typically further out into the future. So as the rate used to discount those future cash flows back to the present increases, as that discount rate increases, those cash flows become less valuable in today's terms. Now, that's a lot to digest, so let's sort of unpack it and use these tables here to help illustrate this concept. In the first table, we have an example of a growth company and an example of a value company. The growth company is Apple, the value company is JP Morgan. And if we continue going across the table, there's a PE ratio, the price to earnings ratio. And for JP Morgan, it is 11 times, and for Apple, it's 31 times. Growth companies trade at higher PE multiples than do value companies. And we can also break that PE ratio down into the stock price, which is $160 for JP Morgan. And I tried to use real numbers where I could, so that this is as real world an example as we could get. $160 for JP Morgan stock. That's $160 over next year's earnings per share of about $15 gets you the 11 times PE multiple. Another way to look at the stock price is that it is the present value of future income associated with that stock discounted back to today with an assumed discount rate that I'll get to in a minute. Here's a really important piece about this table. If you look at the earnings per share from year 1 to year 9, notice how EPS is projected to grow for each company. So in JP Morgan's case, earnings per share, or EPS, is expected to grow 6% per year, and Apple's is expected to grow 12% per year. So compare year 9 earnings per share to year 1 earnings per share. And in JP Morgan's case, it's 60% higher in year 9. In Apple's case, it's 150% higher in year 9 relative to year 1. Cash flows and earnings at Apple are projected to grow a lot faster, but those earnings and cash flows really pick up well into the future. And this is really critical. The timing of cash flows is so important. The farther into the future those dollars are realized or earned, then the less valuable they are to us today. And this is where the discount rate really comes into play. Notice in our assumptions table that the discount rate is 15%. So what we're going to do here, and this is when it really starts to get exciting, so buckle up. Well, growth, and this is really going to drive home the concept of why growth companies, or at least growth stocks, might be under pressure going forward. In theory, tightening monetary policy or tightening financial conditions go hand in hand with a higher discount rate used in a discounted cash flow model or DCF model. So let's look at the bottom table. Let's keep an eye on the bottom table, and I'm going to adjust this 15% right here. So we have formulas in here. And when I change that to 20%, if we look down to this table, the sensitivity of the stock price to that change in discount rate comes into full focus here. JP Morgan's stock price would decline by 36% if the discount rate were to go from 15% to 20%. Okay. Apple's stock price would decline 63% in this example. This is an example. It's an extreme illustration. It's not a projection at all, but drives home the point. Earnings and cash flows from value companies are more certain, and they're being generated in the near term, whereas earnings from growth companies are less certain and are being projected to be generated further out into the future. So I'll leave you with this. Stock prices really have to have a basis in reality. They have to be connected to reality. And that reality should be the present value of cash flows expected to be generated from that company in the future. That's it for this week. Thanks for watching. We'll see you next week.